Tax the rich. That's what a California ballot initiative intends to do, introducing a 5% one-time tax on the $2 trillion net worth of California's 255 billionaires. All in all, the tax was expected to collect $100 billion over 5 years, more than 3 times the anticipated $30 billion Medicaid shortfall. But California's billionaires and business ecosystem are screaming that this tax will drive away California's richest and brightest residents. And here's the thing, they might be right. Sergey Brin and Larry Page, the founders of Google, with a combined net worth of $500 billion have left. Peter Thiel, the founder of Palantir, with a net worth of $26 billion has left. And according to billionaire investor and SPAC queen, Chamath Palihapitiya, nearly $1 trillion of net worth has left the state since the announcement, meaning that at least $50 billion of the anticipated $100 billion is already gone. But it seems not all billionaires care. For example, NVIDIA founder and Tom Ford jacket aficionado Jensen Huang told an interviewer this.
Whatever taxes, I guess, they would like to apply, so be it. And, I'm perfectly fine with it.
This all begs the question, should we tax the rich more? And if so, how? This is Cam from 2 and 20, and this is Death, Taxes, and Billionaires. Wealth taxes are not a new concept. In fact, they've been used across the world many times before, especially Europe. In 1990, there were 12 countries in the OECD with the wealth tax, but today only 3 still maintain it: Norway, Switzerland, and Spain. But why did so many countries abandon the wealth tax? To understand this, let's look at France. France imposed the wealth tax in 1982, but quickly realized that celebrities and business people will do the only thing that makes sense: leave. Okay, so some rich people leave. Who cares? Well, as a result, over the tenure of the tax, France lost 3.5 billion euros per year. But France is not an exception. The very same thing can be said about Sweden. When they introduced a wealth tax, they also saw large outflows of wealthy individuals to lower tax jurisdictions. But here's the thing, it isn't only about capital flight. IMF economist James Brumby notes that the rich are quite sophisticated about avoiding these taxes too. They will take on excessive debt, exploit loopholes, and lobby for exceptions. Furthermore, a wealth tax is very complex and expensive to maintain. Let me use an example to explain this. Let's say I'm a rich guy that owns a private company that sells software to YouTubers. The tax man wants me to pay 5% of my net worth as a tax. How do you determine the value of my business though? There's no public stock as it's privately held, and there are no external shareholders that have invested at previous valuations. Okay, so maybe we hire a firm to independently value the firm. But what firm would want to do that and potentially risk their relationship with me? And even if they do, I can appeal the valuation in court and get another firm that disagrees. Eventually, let's say we determine my company is worth 10 billion. But here's the kicker. I only have 10 million in cash. How do I pay a $500 million tax? Well, I have a few options. The simplest is selling my company, but that's a fire sale, and fire sales never get top dollar. I could take on a ton of debt, but that would negatively impact my company and its employees. But let's say I do pay the tax, and then my business declines by 50% next year. Do I get my taxes back? Hopefully by now, you get the point. A wealth tax is inherently complicated and very easy to lawyer up for. It also introduces tons of negative externalities that can create market fragility. But you might point out, hey Cam, Norway, Switzerland, and Spain still have one, so maybe it works. Let's break this down. Firstly, Spain is a terrible example to use. The country has the highest unemployment rate in the EU, and wealthy regions like Madrid and Andalusia effectively abolished the wealth tax by offering a 100% tax credit. This was recently challenged by the federal government, but it is still in court. Next, we go to Switzerland. Switzerland has a 0% tax on capital gains for selling businesses, stocks, crypto, or your $1 million Pokemon collection. Basically, the proceeds are tax-free. When we compare this to most of the OECD, capital gains are taxed at around 25 to 50%. So what does a net worth tax mean when there is no capital gains tax? The tax is based on cantons, similar to a US state, and can be as low as 0.1% in Zug or Schwitz. Lastly, if you move to Switzerland and don't work there, you can avoid this wealth tax altogether by basically paying an annual tax equivalent to around 7 times your rent. Meaning that if you're worth $10 billion and you rent a lakeside mansion for $2 million per year, you pay a tax of $14 million, or 0.1% of your net worth. What I'm trying to say is, basically Switzerland still has low taxes. Last on the list is Norway. Norway is also just not a great example for many reasons. For one, the country is super rich because of oil. They're basically the Qatar of Europe. If you want to understand this better, you can check out our video that made the Nords extremely happy. Secondly, Norway's wealth tax applies to 1.1% of all wealth above around 170,000 US dollars. Let's try to visualize what this looks like. Let's say you have 500,000 in assets. The government will exempt the first 170,000. That leaves $330,000. At roughly a 1% wealth tax, you're basically writing a $3,300 check every year. If this tax was used in the USA, it would apply to over 50% of the population. Lastly, when they increased the rate in 2022 to 2023, tax revenue declined $594 million as over $54 billion of private wealth left the country. And guess where they went? They went to Switzerland. All in all, the wealth tax is just not effective. But that doesn't necessarily mean we shouldn't tax the rich. Real quick, we're trying to build a community of globally minded super nerds who really want to understand how the world works. If that sounds like you, hit the like button and subscribe for more awesome videos. Now back to the video. As we've shown, a wealth tax just isn't ideal. For one, it's super complex and expensive to manage, easy to avoid, and leads to capital flight and generally loses money. But there are other simpler forms of tax that are likely more effective. The first tax we're going to explore is tax on debt. To illustrate this, let's look at Larry Ellison. Larry is the founder and CEO of Oracle. With a net worth of around $240 billion, Larry is very, very, very rich. He's so rich that he even bought 98% of the island of Lanai in Hawaii and basically commits to bankrolling every media property his son David wants to buy. But here's the fun part. Larry doesn't buy islands and fancy things with income or proceeds from selling stock. Instead, he mostly uses debt. You're going to want to stay with me here. SEC filings from 2025 show that Larry has pledged 277 million shares of Oracle worth around $50 billion as collateral for loans. What this means is that the bank will give him a loan and secure it against the value of his shares. And these loans can be huge, with some reports indicating that he has maintained credit lines as large as $10 billion. But you want to know the really nice part about these loans? They are tax-free. Basically, Larry can use this money to live life, invest, or do whatever and pay no taxes. All he has to do is make his bank payments, which at the interest rates he gets are not hard. But you see, Larry is no exception. Others have used this too. Elon Musk, Jeff Bezos, the Walton family, and more. A tax on this would have a number of benefits. For one, unlike a wealth tax, it is much easier to track and value. This would reduce the cost of administering the tax and the overall complexity. Secondly, people really can't argue that this would stifle innovation, because it only taxes the proceeds and not the equity generation itself. Thirdly, this tax won't disrupt capital markets. Unlike the wealth tax, which would cause significant damage to equity markets and introduce significant risk into the system, this tax would potentially benefit it by removing leverage from the system. And lastly, if billionaires stop taking these loans, they will simply have to sell shares to fund their lifestyles, and those sale proceeds are fully taxable under current law. Equitable Growth estimated that US individuals have $140 billion of outstanding share-backed loans, meaning a tax on this could raise billions per year from loans or billions from capital gains on sales, because shareholders would be more incentivized to liquidate. The next tax we're going to look at is my favorite, inheritance. One of the main arguments against a wealth tax is it disincentivizes business investment and innovation. And empirically, this is true. The reason is pretty simple. People who take risks, well, they want to be compensated. But this doesn't apply to their kids. The US is in the midst of the greatest wealth transfer in history, and it is entirely through inheritance. It is estimated that $16 trillion is set to be transferred in the next 10 years. For comparison, that is 500 times more than California's Medicare shortfall. So how much is set to be transferred? By 2045, $84 trillion is set to be transferred, which is nearly 3 times America's entire debt burden. But here's the thing, taxing inheritance gets a lot of pushback. People will kick and scream that it will reduce business growth, innovation, productivity, and blah blah blah. But this is simply not true. Here's the reality. The only benefit of these large inheritances is to ensure Nepo babies can coast through life and pretend to be self-made. Inheritance itself stifles business growth, innovation, and productivity. Yep, who would have guessed it? Inheritance is damaging. I want you to think about this. If you inherit a big business or a ton of money, you have little to no incentive to grow your pie. You are solely focused on preserving it. So why would you take big risks? Why invest heavily? One of the simplest ways to look at this is analyzing the most innovative companies of the last 30 years. Apple, self-made founders. Google, self-made founders. Microsoft, Amazon, Alibaba, Tencent, Spotify, Shopify, Uber, all self-made founders. There are very few examples of individuals who inherited wealth who at the same time built incredibly innovative businesses. You want to know why? Because there is no incentive. And also, just on a more philosophical note, if you want to create a fair and meritocratic system, why should someone who did nothing receive so much? Isn't that just the opposite of capitalism? Some might call it socialism for the rich. Do nothing and you get a lot. Now, I should say, if you are an astute observer or tax accountant, you might scream, but the US does have a federal inheritance tax. And you would be right. The US has a flat 40% inheritance tax above $15 million of inherited value, or $30 million for a married couple, which means, theoretically, inheriting $1 billion would generate $400 million in taxes, right? Not necessarily. While all inheritance taxes can't be avoided in the US, there are a number of ways to lower the bill. For example, you can use any or a combination of intentionally defective grantor trusts, grantor retained annuity trusts, and FLP-based valuation discounts. I know, a lot to take in, just search it up later. But there is one option that is quite powerful and that many use to establish dynastic wealth: dynasty trusts. The details of dynasty trusts would honestly take a whole video to explain, but at a high level, they significantly reduce the tax bill and can enable rich people to pass on assets to family tax-free for hundreds of years. It was this strategy that was pioneered by the Rockefellers, and it has been used by so many others since. Just to name a few, the Walton family and the Mars family. And the thing is, there is an easy fix to this. Get rid of these structures and loopholes. It's these setups that establish dynastic wealth similar to Europe, where the vast majority of ultra-wealthy people inherited their wealth. Okay, the last one we're going to attack is the carried interest loophole. When private equity, venture capital, or hedge funds raise money, they charge what is known as 2 and 20, the namesake of this channel. To illustrate this, let's use actual numbers. Let's say I start a venture fund called Nepo Baby Capital. I go out to a bunch of rich people and raise $1 billion to invest. Each year, I'm going to charge my investors a management fee of 2% or $20 million. But that's peanuts. The 20% is the real prize. Let's say I turn that $1 billion into $3 billion by making a savvy investment. In doing so, I make my investors a profit of $2 billion. And here's the really fun part. To be fairly compensated, my investors give me 20% of the profit. So in this case, $400 million. And instead of paying income tax, I pay capital gains tax, meaning instead of paying $200 million in taxes, I pay closer to $100 million. Yep, the hedge fund guy pays less as a percent in taxes than a doctor. It's estimated that the US investment management sector extracts nearly $100 billion per year in carried interest, meaning there is likely an additional $15 billion of tax collections per year that could be added by taxing this as income. In conclusion, all three of these are just much more appropriate tax structures than a wealth tax. But there is a bigger question to ask. Does the US need more tax revenue? There is a perception around the world, definitely in the US, that, well, Americans pay little in taxes. But is this true? Thankfully, we can analyze the data. The OECD tracks tax revenue collected by countries across all levels of taxation. And if you look at all tax receipts, the US collects by far more taxes than any other country at 7,481.4 billion. And that number, it excludes Social Security and healthcare. The next biggest country is Germany, which generates 25% the tax revenue as the US. However, the US is also the most populated OECD country. So to get an apples to apples comparison, we should divide that number by population. And if we do this, the US collects the 12th most taxes per person out of 38 developed nations. But then if we remove tax havens, which often have abnormally high tax revenues because of capital inflows from abroad, the US ranks 8th. Not only that, but the US ranks ahead of Germany, France, Australia, the UK, New Zealand, and others. All in all, the US collects 33% more tax per person than the median OECD country. Now, you might be saying, but Cam, they collect less as a percentage of GDP, and that's what matters. And you'd be partially correct. The US does collect less tax as a percentage of GDP. 27% versus the OECD average of 34% to be exact. However, it would be flawed to just look at this statistic. And you know why? Because taxes impact GDP. This idea is summarized by the Laffer curve. The curve shows the relationship between taxes and GDP. And the idea is simple: to tax as much as possible without lowering GDP. But the execution of this principle, it's quite hard. And although no one knows whether the US could increase taxes without impacting GDP, that's not the point. The point is that the US seems to collect a lot of taxes even with its current policies in place. Which begs the question, how does the US collect so much? The main reason is income tax. Around 40% of all US tax revenue comes from income, versus 24% across the OECD. Most OECD countries rely more heavily on value-added taxes, which are taxes on consumption. And personally, we believe that consumption taxes are just not a good idea, and they generally punish low-income earners. What's more is that the US has high average property taxes compared to the OECD. But this is one of the reasons the US on average has a lower home price to income ratio than EU countries. And lastly, the US tax figure doesn't even include Social Security and healthcare, which if included would push the US near the top of tax collection. So what is the point with all of these boring numbers? Well, taxes might not be the solution. Now, to be clear, we do believe that leverage on equity to live tax-free is bad and inheritance loopholes should be closed. But as we have shown, the US collects a lot in taxes, and maybe they could collect a little bit more. But if the US collects so much, but the services and quality of life measures lag peer nations who collect less, maybe it isn't simply a tax revenue problem. Maybe this also has something to do with spending. And I know we're going to lose a lot of people here, but just give us a chance. For one, the US healthcare system is terribly expensive. If the US had a healthcare system similar to other Western nations, the country could save $3 trillion per year. This alone would basically solve everything. And we did a deep dive into just how broken the system is, and in it we show that the issues are purely structural and absolutely solvable. Moreover, the US spends a crazy amount of money on defense. In fact, the Pentagon has never passed a single audit. If any company failed audits like the Pentagon, they would have their whole executive team and board imprisoned. Then there's pure fraud. The Government Accountability Office, not to be confused with DOGE, reported $236 billion in improper payments in 2023 and $162 billion in 2024. And since 2003, that total number is around $2.8 trillion. Our point is simple. If you increase taxes but don't solve the grift, nothing is ever going to get fixed. There is a lot of frustration in the US that the rich are just not paying their fair share. And we get it. Costs are rising, healthcare is not improving, and life, it's just getting harder. But the approaches taken by groups to fix the issue, in our view, are misguided. A wealth tax has been tried time and time again, and it has been shown time and time again to not be effective. Yet people keep asking for it. While at the same time, little is discussed around taxing debt on equity, closing loopholes on inheritance, and taxing carried interest as income, each of which is very easy to address and much easier to execute. Furthermore, the US already collects a lot in taxes, but clearly things aren't improving. So what good will come from more taxes? And in our assessment, taxes can be useful, but they are no silver bullet. And even if this bill passes, we are confident that it won't solve anything. Our thoughts are summarized perfectly by Parkinson's law. Expenditure rises to meet income. Thank you for watching. We have a free Discord community in the description below. We actually chat in there and hang out, so please join.